Centre for Independent Living Northern Ireland is pleased to present surplus calculations and costs and requirements to consider. A build-up of funding within your direct payment account is common and over time is to be expected in most cases. An apparent build-up of funds, however, does not always mean that you have a surplus. A surplus is defined as an amount of something left over when requirements have been met. It's these requirements that need to be considered and calculated to truly know if you have a surplus of funds. At CIL-NI, we often refer to the result of these calculations as your true surplus. The balance in the account you use to manage your direct payments is likely to change and fluctuate on a weekly, 4-weekly, or monthly basis. So first, it's important to pick a date on which you wish to calculate your surplus. Once you have chosen the date you intend to use to work out your calculations, you must answer all of the following questions based on that date. The first question is, how much is your direct payment account as of that date? What is the bank balance? Then, the first deduction is your 1 month, 4-week or 5-week advance payment from your local health and social care trust. To do your calculation, you will need to know which of the 3 advance payments applies to your direct payment arrangement, as each health trust varies. If you're unsure how much your trust has paid you in advance, you may wish to simply multiply your weekly direct payment amount by 4.5. The advance payment is for cash flow purposes and your trust will expect this back when the direct payment comes to the end of the arrangement. Therefore, you cannot spend it. Next to consider, on your chosen date, are there any outstanding invoices, written checks, or bank transfers that have not yet been deducted from your direct payment account? Then, most importantly, you'll need to deduct your entire next payroll cost if this is due before you receive your next payment from your local health and social care trust. Don't forget your full payroll cost may include employers' national insurance contributions and employers' pension contributions, as well as your employees' gross pays. Next up, do you have any standing orders or direct debits to be collected before your next payment from the trust? You may also have costs that aren't related to employment. Do you have any other support costs agreed with your social worker or trustee worker that are written into your support plan? Keep in mind you might need funding for other types of support or for emergencies. Other costs to consider and have extra funds available for include significant increases in the national living wage or, for example, new or additional pension costs should an employee opt in. While calculating your surplus, other costs to consider are the use of agreed service providers. These might include care agencies or self-employed personal assistants, as well as any other support organisations. If you don't pay via direct debit, do you need to save toward the renewal of your employer's public and liability insurance? If yes, how much should have been saved to date? Some final things to take into account are your employee's annual leave and any other statutory entitlements still owed to your staff. Entitlements still owed usually means you need to have the funding set aside. Annual leave would be the most prominent of these. It's not uncommon for an employee to approach the end of their holiday year with annual leave still remaining. Therefore, it's important that you deduct annual leave owed from any apparent surplus, as well as accounting for any annual leave carryover you have agreed with your employees. Maternity and paternity leave is paid leave for those employees who meet the eligibility criteria. If you have received payments in advance for maternity or paternity leave from the government, then you will also need to account for these in your calculations. For help with calculating how much you should be retaining to cover your staff statutory leave costs, it is best to consult your accountant or payroll service. Alternatively, you can also call your insurance provider's 24-hour legal advice helpline. Last but not least, If you run a 4-weekly payroll and are paid monthly by your local health and social care trust, then you will also need to account for savings toward your 13th pay period. The reason for this is that you would receive 12 payments into your bank account, but would be paying for 13 payrolls within the financial year. If the final calculation is a loss, then you're in a poor financial position. This means that you should not pass on any wage increase to your workers until you have saved enough money to cover all your employer's costs. If the final calculation is a surplus, then you're in a good financial position and you are able to consider giving your workers a pay rise. In terms of backdating their pay rise, however, this will depend on the amount of surplus you have. Due to possible overspends, not everyone will have enough surplus to backdate to April 1st of the current or previous tax year. Therefore, you should check with your payroll service provider or accountant how far back your surplus will allow you to pay your workers. For advice or more information, please contact Centre for Independent Living Northern Ireland on 028 9064 8546 or email inquiries@cilni.org.